One name, one nomination, and silver crashed 31.4% in a single day. When President Trump nominated Kevin Warsh as the next Federal Reserve Chair, spot silver plunged 31.4% on Friday, its worst single day since March 1980. Carbon credits not a correction, not a pullback. The worst single day for silver in 46 years. Silver followed with an even more dramatic flash crash, dropping from $120 to below $85 in the 48 hours following the announcement, trading key. And here's what makes this more complex than any headline is telling you. Traditionally viewed as a hawk, Warsh's stance has become more dovish in recent years, having publicly supported aggressive rate cuts in late 2025 and early 2026, citing AI-driven productivity gains that could curb inflation without job losses. Metals Daily. So the man who just caused the worst silver crash in 46 years is actually a rate cut supporter. The market panicked over a hawk, and the reality is considerably more complicated than that panic. I am not going to tell you silver is going to $200 tomorrow. I am not going to tell you the bull market is over. What I'm going to do is walk you through exactly who Kevin Warsh is, exactly what his nomination means mechanically for the Fed, the dollar, and silver, exactly why the market reacted the way it did, and exactly what the three most likely scenarios look like for silver from now until May 15th, when Jerome Powell's term actually ends. Because here is the thing, the market just gave silver holders one of the most important tests of this entire cycle. Whether you passed that test or failed, it depends entirely on whether you understand what actually happened and what actually comes next. Let's build it from the ground up. Every number I give you today is public and verifiable. Links to all data sources are in the description. Section 1. Who Kevin Warsh actually is, because the market got this wrong on day one. Before we get into what this nomination means for silver, you need to understand exactly who Kevin Warsh is, because the initial market reaction was built on a caricature of the man, not the reality. Kevin Maxwell Warsh is an American financier and bank executive. He served as a member of the Federal Reserve Board of Governors from 2006 to 2011. During and in the aftermath of the 2008 financial crisis, Warsh acted as the central bank's primary liaison to Wall Street and served as the Federal Reserve's representative to the Group of 20 and as the board's emissary to the emerging and advanced economies in Asia. Prior to this, he served as Special Assistant to the President for Economic Policy and Executive Secretary of the White House National Economic Council under President George W. Bush. CNBC Warsh served as a Fed governor from 2006 to 2011, becoming the youngest governor in the bank's history. He is a former Morgan Stanley banker and served as the Fed board's liaison to Wall Street during the 2007 to 2008 financial crisis. The Street. This is not a political operative. This is not a Trump loyalist with no monetary policy experience. This is a man who sat at the center of the Fed's crisis response during the worst financial collapse since the Great Depression. He knows the plumbing of the central bank better than almost anyone alive outside the building. Warsh would succeed Jerome Powell, whom Trump has repeatedly attacked for declining to cut interest rates. If confirmed by the Senate, Warsh would begin his 4-year term after Powell's term ends on May 15th. J.M. Bullion. Now here's the critical distinction that the market missed in its initial panic. There are two Kevin Warshes that the financial media has been describing, and they are both real. Warsh the hawk, the man who dissented against QE in 2010, the man who criticized the Fed's aggressive rate cuts, the man who wrote a Wall Street Journal op-ed calling the Fed's balance sheet bloated and warning about inflation risks long before inflation became the consensus view. Warsh the pragmatist, the man who has also recently echoed President Donald Trump's demands for lower rates. Warsh says that productivity gains from artificial intelligence will help the economy grow more quickly without spurring inflation, enabling the Fed to reduce borrowing costs. Market Pulse Warsh is currently in favor of greater policy easing in 2026, driven by a view that productivity gains could boost U.S. economic growth without driving higher inflation, therefore allowing rates to come down. Trading key. The market on January 30th priced in Warsh the hawk and crashed silver 31%. The data on Warsh the pragmatist suggests the reality is considerably more nuanced, and that nuance is where the silver opportunity lives. Section 2. Why silver crashed 31%? The exact mechanical chain. Let me give you the precise sequence of events that took silver from $120 to below $85 in 48 hours, because understanding the mechanism is more valuable than just watching the damage. The sharp downturn in precious metals prices was triggered by a confluence of factors. The primary catalyst was Trump's nomination of Kevin Warsh as the next Federal Reserve Chair, interpreted as a hawkish signal favoring tighter monetary policy and a stronger U.S. dollar. This nomination reduced expectations for aggressive rate cuts, making non-yielding assets like precious metals less attractive. Substack. That is the first domino. Warsh nomination. Market reads hawk. Rate cut expectations fall. Dollar strengthens. Silver priced in dollars globally becomes more expensive for every buyer outside the United States. Paper demand drops, price follows. But it did not stop there. Additionally, the CME Group raised margin requirements on metals contracts by 2 to 4 percentage points, exacerbating forced liquidations and margin calls among leveraged positions. Substack. So while the fundamental repricing was happening from the Warsh nomination, the exchange simultaneously raised the cost of holding silver futures positions. Leveraged traders who could not meet the new margin requirements were forced to sell, not because they wanted to, because they had to. Forced liquidations into a market where buyers had already pulled back. Technical factors played a role as the rally had become overextended with parabolic gains. Gold was up 29.5% and silver 68.5% in January, leading to overbought conditions and RSI divergences signaling impending corrections. Substack 3 forces hitting simultaneously. Fundamental repricing from the nomination. Mechanical selling from margin hikes. Technical exhaustion from a 68.5% January move. Any one of those 3 forces alone would have caused a pullback. All 3 hitting in a 48-hour window produced the worst silver day since 1980. As the US dollar index surged by over 1% in a single session, the CME Group exacerbated the sell-off by raising margin requirements for gold and silver futures. This triggered a cascade of margin calls, forcing leveraged traders to dump positions into a vacuum of buyers. By the time the dust settled over the weekend, billions in paper wealth had been erased from the precious metals complex. Trading key. That is what happened. A perfect storm of fundamental mechanical and technical forces all pointing in the same direction simultaneously. Now here's the question that actually matters for silver holders. Did any of that change the physical supply and demand picture? Did the Warsh nomination close the COMEX registered vault from 86 million ounces to 200 million ounces? Did it end the 6 consecutive years of structural supply deficit? Did it bring Fresnillo's cut production back online? Did it stop Samsung from locking up direct mine output? No. None of those things changed. What changed was paper market sentiment, and paper market sentiment is the most volatile and least reliable indicator of where silver goes over a 12 to 24-month horizon. Section 3. The Senate confirmation problem. Why May 15th is not a clean handover. Here is the part of the Warsh story that almost nobody is covering properly. And it directly affects when and whether the monetary policy shift the market panicked about actually happens. Warsh must be confirmed by the Senate to serve as chair. That process starts with the Senate Banking Committee, which could spell trouble for Trump. Retiring Senator Thom Tillis has vowed to block any Fed nomination as long as a Justice Department investigation into Powell over his testimony to the panel about Federal Reserve Office renovations in Washington remains ongoing. Tillis is a key vote on the Banking Committee, which handles confirmation hearings for Fed appointees and has a narrow 13-11 Republican majority. J.M. Bullion, let me translate that into plain arithmetic. The Senate Banking Committee has 13 Republicans and 11 Democrats. If Tillis votes no, Republicans are down to 12 votes. If Democrats vote as a bloc against Warsh, the nomination does not pass out of committee. It never reaches a full Senate vote. Warsh's nomination, which was initially announced January 30th, was forwarded to the Senate Wednesday, where it will be taken up by the Senate Banking Committee. Yet the nomination could stall there. Senator Thom Tillis, a North Carolina Republican on the committee, has said he will oppose confirming Warsh until a criminal investigation into Powell is resolved. Fortune Tillis, who is not seeking re-election in 2026, subsequently said he will block Warsh's nomination for the remainder of the 119th United States Congress if the investigation continues until his term expires in January 2027, CNBC. Read that carefully. Tillis is not seeking re-election. He has nothing to lose politically. He has said he will block the nomination for the rest of his term. His term ends in January 2027. Powell's term ends May 15, 2026. If Tillis follows through on his stated position and Democrats vote against Warsh, Powell could serve past his chair term in an acting capacity, or the seat goes vacant, or Trump makes a recess appointment. None of those outcomes produce the clean, hawkish policy shift the market priced in on January 30th. Senator Kevin Kramer of North Dakota, who is also on the committee, has condemned the investigation as an intimidation tactic by Trump. Market Pulse, 2 Republican committee members publicly uncomfortable with how this nomination is proceeding. In a 13-11 committee, losing 2 Republicans is the difference between confirmation and stalemate. The market crashed silver 31%, assuming Warsh becomes Fed chair on May 16th and immediately pivots policy. The confirmation math says that assumption is far from guaranteed, and the silver price has not fully absorbed that uncertainty. Section 4. The hawk or the dove. What Warsh actually does when confirmed. Let's assume for this section that Warsh gets confirmed. He sits down in the Fed chair's seat on May 16th or shortly after. What does he actually do? Here is the honest answer. Nobody fully knows. And here is why that uncertainty is more bullish for silver than bearish. Warsh is known for his hawkish views and long-standing critique of quantitative easing. However, he has also advocated for closer alignment between the Fed and the U.S. Treasury, and use of the Fed's balance sheet could be employed to help tackle housing affordability, a key priority of the Trump administration. Therefore, it would not come as a surprise if Warsh were to take a more pragmatic approach to balance sheet management despite his past comments against such action. Trading key Warsh's stance has become more dovish in recent years, having publicly supported aggressive rate cuts in late 2025 and early 2026, citing AI-driven productivity gains that could curb inflation without job losses or a recession. His upcoming interviews should clarify how he asserts these views. Markets are still assuming around 2 rate cuts for 2026, metals daily. 2 rate cuts still priced in, with a man who publicly supports rate cuts now nominated to lead the institution that makes those cuts. That is not the hawkish apocalypse the market priced in on January 30th. Warsh is widely viewed as a serious, independent monetary policy thinker, not someone who would simply rubber stamp White House preferences. Institutional credibility matters for preserving confidence in the Fed and the strength of the dollar. Financial content. A credible independent Fed chair who supports rate cuts in 2026 because AI productivity gains contain inflation. That is the actual description of what Warsh has been saying publicly. That is the scenario the silver crash did not price in. It priced in the 2010 version of Kevin Warsh, the man who dissented against QE, not the 2026 version who is publicly calling for rate cuts based on structural productivity arguments. Silver experienced an extraordinary rally in January, surging nearly 50% over the month alone. Citigroup forecasts that spot silver could reach $150 per ounce within the next 3 months. On January 26th, silver set a new record at $117.70 per ounce, including a single session gain of 14%, the largest since the 2008 financial crisis. TechFlow Citigroup, $150, 3 months. That forecast was made after the Warsh nomination, with full knowledge of who he is. By the same Citigroup that has access to better information about Fed policy trajectory than any retail investor. They did not pull their $150 silver target after Warsh was nominated. They maintained it. Section 5. The bear case. Why the crash might have been right. I always give you both sides. So here is the strongest version of the argument that the 31% silver crash was appropriate and the bear market continues. The nomination of Kevin Warsh has fundamentally altered the landscape of the 2026 financial markets. By dismantling the narrative of monetary subordination, the Warsh effect has successfully re-anchored the US dollar and punctured one of the greatest speculative rallies in the history of precious metals. The debasement trade, which felt like a sure bet only weeks ago, has been revealed as a crowded and vulnerable position. Trading key. The bear case argument is coherent. Silver's move from $80 to $121 in January was a 51% move in 30 days. That is not a bull market. That is a parabolic mania. Mania is correct. They always correct. The Warsh nomination was the pin that popped the balloon, and balloons that pop do not immediately reinflate. The Warsh shock has fundamentally realigned market expectations, pushing any hopes for a mid-year rate cut into late 2026. Compounding the macro pressure, the CME Group announced a drastic 36% hike in maintenance margins for silver futures. This forced a wave of forced liquidations as over-leveraged speculators were unable to meet the new collateral requirements. Financial content. If Warsh is confirmed quickly and signals hawkish rhetoric at his first FOMC meeting, rate cut expectations for 2026 could evaporate entirely. Dollar stays strong. Silver faces a prolonged period of consolidation between $75 and $90. The physical bull market thesis is intact, but the paper price does not reflect it for another 6 to 12 months. Silver holdings fell for a 7th consecutive session to their lowest level since November 2025. Futures data also show speculators cutting back sharply on bullish bets, signaling a broader retreat from the sector. Managed money net longs in COMEX silver took positioning to its lowest since February 2024. A-Invest 7 consecutive days of ETF outflows. Speculative positioning at a 2-year low. That is not a market getting ready to bounce. That is a market that just broke a crowded trade and is still deleveraging. The bear case is real. I am presenting it fairly. The path back to $100 silver requires either a soft NFP today that weakens the dollar, a Warsh confirmation hearing that reveals more dovishness than the market expects, or a continuation of the physical delivery stress at COMEX that forces the paper price to acknowledge physical reality. None of those are guaranteed. All of them are possible. Section 6. The 3 scenarios for silver from now through May 15th. Here are the 3 most likely outcomes for silver between today and the date Powell's term actually ends in order of probability. Scenario 1. Confirmation stalls. Silver stabilizes. Most likely. Tillis follows through on his stated position. Senate Democrats vote against Warsh. The nomination stalls in committee. Powell continues in an acting capacity or the seat goes temporarily vacant. Rate policy stays exactly where it is. The market's hawkish repricing partially unwinds as the reality of the confirmation math becomes clear. Under this scenario, silver stabilizes in the $82 to $90 range through March and April. The physical delivery stress at COMEX continues. The structural supply deficit continues. The paper price does not recover to January highs but stops the bleeding and begins to base. The setup for the next leg higher rebuilds quietly while mainstream attention is focused on the Washington political theater. Scenario 2, Warsh confirms quickly and signals pragmatic dovishness. Possible. The political obstacles clear faster than expected. Warsh is confirmed before May 15th. In his first public statements as confirmed Fed chair nominee, he emphasizes the AI productivity thesis for rate cuts. He distances himself from the 2010 hawkish Warsh that the market feared. Rate cut expectations for 2026 rise. Dollar softens. Silver recovers toward $95 to $105 as the physical supply stress and the easing monetary narrative realign simultaneously. This is the scenario Citigroup's $150 target is built around, not an immediate recovery but a progressive one through the second and third quarters of 2026. Scenario 3, confirmation fails entirely. Wild card. Tillis and Democrats successfully block Warsh. Powell's term ends May 15th. Trump makes a recess appointment of a different Fed chair, one of the more politically compliant candidates rumored during the selection process. Under this scenario, the market faces a completely different repricing. A Fed chair seen as a Trump puppet would devastate dollar credibility. Capital would move aggressively into hard assets. Gold and silver would not just recover January highs, they would meaningfully exceed them. This scenario is less likely, but it is not impossible. And the silver price behavior in this scenario would be dramatically bullish. Section 7. What the rebound already told you. Here is the data point that the bear narrative is trying to bury. After getting battered since late last week in a dramatic sell-off, precious metals rebounded and clawed back losses on Tuesday as investors continued to digest the implications of Trump's announcement. Gold rose more than 3% in Asian trading to $4,120 an ounce, and silver surged 5.3% to $83.50. Investors were likely drawn to the historically low prices after gold spent most of 2025 on a steady rise. A-Invest silver crashed 31% on Friday. By Tuesday, it had bounced 5.3%, from below $80 to $83.50 in 2 trading sessions, without any new fundamental catalyst, without a Warsh policy reversal, without a Fed announcement, without a supply squeeze resolution. The bounce happened because at some price level, the physical reality of silver's supply deficit overwhelms the paper market's sentiment-driven repricing. That price level revealed itself in the $78 to $80 range. While precious metals prices are declining, experts agree these are entering 2026 with notable momentum. Silver experienced an extraordinary rally in January. Citigroup forecasts that spot silver could reach $150 per ounce within the next 3 months. TechFlow. The rebound is the market telling you where the physical floor is, not the paper floor, the physical floor, the price below which industrial users and physical accumulation absorbs all available supply. You just found out where it is. Section 8. What to watch between now and May 15th. Everything on this list is public and free. I sell nothing. No memberships, no Discord, no paid alerts. If you see my name on any paid service, that is not me. You find me here on YouTube and on X. And Senate Banking Committee proceedings. Watch for a scheduled confirmation hearing date for Warsh. If the committee sets a hearing, the path to confirmation is open. If no hearing is scheduled by April, the stall scenario is playing out. Committee schedules are public on the Senate Banking Committee website. Warsh public statements. Every interview, speech, and public appearance Warsh makes between now and his confirmation hearing will be parsed by the market for signals about his actual policy intentions. Watch specifically for any language about the AI productivity thesis for rate cuts. If he leans into that narrative publicly, the hawkish repricing of January 30th partially unwinds. CME FedWatch tool. Watch the probability of rate cuts at the June and July FOMC meetings. If cut odds rise above 70% for July, the monetary narrative that drove silver's January rally is rebuilding. If cut odds fall below 40% for July, the hawkish scenario has more runway. Silver spot price key technical levels. Silver is expected to benefit from persistent deficits and industrial demand, targeting $88 to $100 through the period, though volatility remains high. Substack watch $85 as immediate resistance. A sustained close above $85 signals the rebound has legs. Watch $78 as the structural floor. If that holds through the confirmation uncertainty, the physical market has spoken. COMEX registered inventory. Whatever happens in the Senate, the physical vault keeps draining or refilling independently of Washington politics. If registered silver continues draining below 80 million ounces, while the paper market is distracted by confirmation theater, the structural squeeze that started this cycle is still running in the background. Section 9. The honest conclusion. Here is the full picture as of this morning, March 6, 2026. President Donald Trump officially nominated Kevin Warsh to be the next chairman of the Federal Reserve. Warsh, if confirmed by the Senate, would succeed Fed Chairman Jerome Powell for a 4-year term. Powell's term ends May 15th. Carbon credit silver plunged 31.4% on the day of the announcement. Its worst single day since March 1980. Carbon credit silver dropped from $120 to below $85 in the 48 hours following the announcement. Trading key, the nomination could stall in the Senate Banking Committee. Senator Tom Tillis has said he will oppose confirming Warsh until a criminal investigation into Powell is resolved. If all Democrats on the committee voted against Warsh as well, the nomination would not pass out of committee to the full Senate. Fortune Warsh is currently in favor of greater policy easing in 2026, driven by a view that productivity gains could boost U.S. economic growth without driving higher inflation, therefore allowing rates to come down. Trading key. Markets are still assuming around 2 rate cuts for 2026. Metals. Daily silver surged 5.3% to $83.50 by Tuesday as investors were drawn to historically low prices. A-Invest 3 scenarios. Confirmation stalls and silver stabilizes as physical floor holds, most likely. Warsh confirms and signals pragmatic dovishness. Silver recovers toward $95 to $105 as possible. Confirmation fails entirely, and Trump makes a recess appointment. Silver dramatically exceeds January highs. Less likely, but not impossible. The physical supply deficit did not change on January 30th. The COMEX vault did not refill on January 30th. The Samsung and Tesla mine offtake deals did not reverse on January 30th. The Bank of America $135 to $309 forecast did not get withdrawn on January 30th. What changed on January 30th was paper market sentiment, built on a caricature of Kevin Warsh that ignored his 2025 and 2026 public statements supporting rate cuts, built on a confirmation assumption that the Senate math does not support, built on a parabolic trade that was already technically exhausted after a 68% January move. The market gave you a 31% discount on silver. Whether that discount was rational or emotional is what the next 60 days of data will resolve. The Senate proceedings, the Warsh public statements, the COMEX delivery reports, the CME FedWatch cut probabilities. Watch all of them. The data will tell the story. Your job is to actually look at it. Invest with logic, not hype. Protect your capital. A 31% crash in 48 hours is the market's way of testing whether you understand what you own and why you own it. The minority who understood the physical story before January 30th did not change their view on January 31st because a paper price moved. They simply watched the data and adjusted their positioning when the evidence actually changed. The evidence on the physical silver market has not changed. Drop Warsh Watch in the comments if you are tracking the Senate Banking Committee proceedings alongside the COMEX vault numbers. Both stories are running simultaneously, and both matter.